Okay, everybody, welcome to our webinar. We're going to talk about the Quantopian Open. My name is Dan Dunn, and I'm the VP of Product and Community here at Quantopian. And the putting together the contest was a team effort, and there's a bunch of people from on the Quantopian team who did it. But I've been one of the product. I'm the product manager for it, so I think I'm pretty well equipped to answer just about all your questions as we go. So I'm saying that I invite you to ask questions as we go along. I love answering questions on the fly, and so you should just click the Ask Question box, the button that you see there on your screen, and it pops up on my screen, and if I can answer it right then, I will, and if I can't, I will tell you, and I'll get to it in a little bit later on in the presentation. So, what are we talking about today? Our topics are, first, I'm going to talk about a little bit about what this has done for us for learning about paper trading. I'm going to talk about the disqualification problems we had early on. I'll talk about some nuances of the scoring system. I'll talk about some of the people's trying to cheat the system a little bit. And I will talk about last month's winner and a couple outstanding issues. And of course, then I'll answer any more questions, but you should go for it. So the first thing I'm going to talk about is how we've decided to use the paper trading records that we see in Quantopian to help build our hedge fund. This actually started as the last slide in my presentation, but I realized that I hated burying the lead all the way down at the bottom, so I just wanted to talk a little bit up here. Quantopian is, of course, building a hedge fund, and this graph that you see here, obviously, when you're building a hedge fund, obviously, you're looking for a higher Sharpe, but you're also looking for a higher Sharpe in a sustainable and lower way. And one of the holy grail of a hedge fund is the number of uncorrelated return streams. So if you have a bunch of return streams, like algos in your fund that all behave exactly the same, then you're putting all your eggs in one basket. But as you add the number of return streams, your overall Sharpe can go up. And one of the things that this contest has done for Quantopian over the last couple months is that we've been able to convince ourselves that we can work and build things using just paper trading. And so when we first announced the hedge fund back in October, we said that you had to trade real money in order to get into the hedge fund. We don't think that's true anymore. Now we think that you're going to be able to do like anyone who's in the contest, for instance, your algo can be potentially in the hedge fund if it performs well, then it's uncorrelated with everything else. So, having said that, let's talk about what got in. So many disqualifications. This is number of disqualifications, disqualified algos by week, and you can see that especially early on, we were losing a lot of entries early on. The orange, it means that the algo went into an exception, and those are kind of harder for us to manage, just because we need to build a better platform such that they're less likely to go into exception and it's easier for you to work around. But a lot of those were people who weren't used to live trading at all, and so their algos weren't protected against things like bars that don't have any data in them because there was no trades in that minute. Things that actually, like, they're real, quote-unquote, real-world problems, and you need to, as an algo writer, you have to protect yourself against some of the real-world things for your algo to make it all the way through. The other two things were people who are over-leveraging. If you borrow too much money, then we disqualified you from the contest. It's just one of the rules that we put in because there's a limited amount of borrowing that you're going to be able to do within the hedge fund, and so we wanted to simulate some of that. And also the do not trade list. People were trading things on a list of stocks that we didn't want them to be able, or specifically ETFs, that we didn't want people to have in the contest. And so you can see we had in the beginning we struggled with disqualifications. So what did we do? The answer is provide better tools. The first thing we did one of the big things we did was manage the do not trade list. So why do we have that do not trade list in the first place? Typically, a lot of the things that we put on the do not trade list are very hard to short, and intrinsically the strategies that make use of these are ones where you do short them, and if you can't short it, then it shouldn't be something that you should be trying to short. It just doesn't work, and we don't have it's easier to just make it so you can't use them. The other thing is that most of these things are leveraged ETFs, And if we're using an ETF that is leveraged, then it's very hard for us to know your true leverage. So we excluded those. And anything that's going on in a leveraged ETF, or any ETF pretty much, you can rebuild yourself in your own algorithm. And so we figure, don't use that ETF, but build the basket of stocks in your own things. So down at the bottom, that hyperlink there, I'm going to put these slides up later, and the hyperlink will click you and take you to the example that you can use, but I just have a screenshot of it right here. You can see within the initialize what it does is it says a set do not order list, and it says don't, in the list of stocks is this leveraged ETF list. And then down in handle data, every time you're about to order something, you should check and make sure it's not in that list. And then so and obviously you could put that logic somewhere else in your code. That's just a very simple way of where we're doing it. All right. Andrea asked me a question about the 100K, and Andrea, I'm going to push that down a little bit later when I talk about the winner. But I will get to your question. All right. So the second thing we did to provide better tools is leverage, and we just didn't make it easy enough in the beginning to track your leverage. And so now what we did is we added leverage to the context object, and so now you can see how leveraged you are. And once you do that, then you can start putting logic around it such that if you're getting close to over leverage, then you can start liquidating your positions. Or if you're going to take a position that would leverage yourself too much, you can prevent yourself from doing that. And so once we put in these tools, the number of exceptions dropped pretty strongly. So, I guess my apologies to some of the people who entered the contest early before the early contest had more sharp edges, but the good news is for the people who are entering the contest now, there are fewer sharp edges and it's easier to get a successful entry in. So the next thing I want to talk about was just a little bit about what we learned about our scoring system. Is especially early on when you start paper trading, your max, if your algo starts in your first 3 days of your algo, you don't lose money. Your max drawdown is effectively 0, and which makes you have a really high ranked max drawdown, because of course your max drawdown can't be a positive number. It ranges from 0 to, I guess, 100%. And so if you're close to 0, then you're number 1 in max drawdown. And the CalMAR ratio is divided by your max drawdown, which means that you can have an insanely high CalMAR ratio in the very beginning. And so then that first day that you have a bad day and your max drawdown, is like 0.5% or even like 1 or 2%. Wham, your score got brutalized. And so that definitely means that in the beginning we see a lot of noise in the leaderboard when there aren't that many days traded. And as the number of days traded goes up, then the leaderboard begins to stabilize somewhat. So we're definitely, I'm not a fan of the fact that this is so noisy in the beginning, but I also haven't really found a good way to solve it, because it's just inherently we're working with a very small amount of data in the very beginning, and it's a hard thing for us to manage. All right. Next thing we had to deal with was cheaters. Cheaters never win, is what we say. Real money, if you offer real money, if you say, we're going to give you a chance to essentially free money, because if you, as you all know, when you win the Quantopian Open, you get to manage $100,000 of Quantopian's money, which is, as some people think about it, it's a free option. You have for $0, you get an option for some real dollars, and that brings out all sorts of behavior. In this case, the behavior was, how can I wangle my way into that leader's seat? The cheater's playbook is to build a perfect back test, and so that maybe what you do is you record the history of SPY, and then you buy and sell SPY in your back test, and then once the real money trading starts, then you flip a coin and you say, I'm going to go long SPY, or you say, I'm going to go short SPY, or maybe you're going to go long volatility. And so we definitely saw a few people who are doing things like that. And so what we did is we started building a way to compare the in-sample and out-of-sample data. And so if your algorithm starts behaving wildly different after the kickoff date, then we disqualify you. And so we've had to remove 2 or 4 people so far, and I will say I'm pretty certain that we haven't removed anyone we shouldn't have, because every single one of them has kind of turned their tail and left once we disqualified them. We haven't had anyone say, no, it wasn't me, I'm being good. And if that happens, we'll definitely take another look, but so far I'm feeling pretty good about the method we're using. And which actually also leads us to, we've got a rule change coming in April. Even if you're not malicious, even if you're just we want your in-sample algorithm and your out-of-sample algorithm, in-sample data and out-of-sample data, which is to say your backtest and your paper trading. We want your algo to be consistent in both those things, because that's a sign of a good, well-written algo. And so even if you're not malicious, even if you just, you made a mistake and you data snooped or you curve fitted or you did something in your backtest that made it such that it wasn't that good of an algo, once you start paper trading, then your algorithm isn't going to be able to perform in the same way it did during the backtest. And so we're adding a factor such that we're comparing your performance of your paper trading to your backtest. And if they begin to differ, or if they differ strongly, then you're going to effectively get a penalty. So what we're doing is we're looking for consistency between your in-sample and your out-of-sample data. And the more consistent you are, the better you're going to perform. And the less consistent you are, the more poorly you're going to perform. I'm kind of expecting I get a question on that one, but we'll see. It hasn't happened yet. All right, so let's talk about last month's winner. Last month's winner was Grant. Grant is well known to us here at Quantopian, and he's well known to just about anybody in the Quantopian forums. This is a picture. This is his profile. I'll just point out that he has 2,079 posts. He has been in our, and he is, and they're not just like him saying hi. He adds a lot of content, a lot of value. So we were really excited when he won the contest. We were really proud of him, and it was, we're delighted to have him with us. And Andrea with another question that Andrea, I'm going to punt on that one just for a little bit, just so I can keep my story. So Grant, but then what happened? Grant won on the end of February 27th, and he started trading on March 2nd, and this was the screenshot I took of the winners page this morning when I was making this presentation, and he's down 5.8%. Ouch! Grant! That's so sad. I mean, we were so pulling for him. We want him to, and he has 6 months of trading yet, and so it may turn itself around, and he may figure it out, and his algo may, make itself back up over 100,000. But right now, it's not particularly pretty. So what happened? And I am going to go to the Quantopian research platform to show you what happened. So I think you guys can see my screen right now. And what I'm logged into Quantopian in my account. You can see like I've got this little red admin square, and that's my name in the upper right, my picture up in the upper right hand corner. And I spent a couple minutes this morning, and I wrote something in the Quantopian research platform so that I could show you what happened. And so what I've got here, if you haven't seen the research platform yet, it is an IPython notebook where you have access to our pricing data. Our fundamentals data is coming into it pretty soon. You have access to your back tests and your live, and in the future you'll have access to your live trading. So basically you can do a whole bunch of analysis even before you write an algorithm within here. And my first cell here says data equals get pricing of SPY, start date of February 2nd, which is of course the date that the contest started, and the end date of March 2nd, and get the close price field and then plot it. And so what I do is I press control return. Oh, no, my keyboard's screwed up. I'm just hitting the play button. And it is, why is it, uh-oh. Let's do a quick reload. Don't you love it when you, don't you love it when you try to do a live demo and sometimes it just doesn't work exactly the way that you hoped it would? Oh, look at that! Contest webinar. All right, we're going to try it one more. There we go. Look at that. Sorry about that. So this is the price of SPY, which is, of course, the S&P 500 as an ETF for the month of February, which is when Grant's algo was leading the pack. And you can see that S&P 500 went up like a rocket through the period that Grant was ahead. Now let's look at what happened since then. Oops, I apologize. I came back. I coughed and I muted myself and then I came back. Thank you for telling me that I said. So what I was trying to say is you can see that Grant, it went up like a rocket through the judging period. So Grant had a fantastic month that came in first, but then it was like a switch. As soon as the winners period started and Grant started trading real money, the market turned and has really sagged since then. And so what we can see here is that Grant's algo was unfortunately really strongly correlated with the S&P 500. I don't know what his algorithm is. I don't know what it does. I don't know what his code is. I don't know what his logic is. But I can definitely tell you it's correlated to the S&P 500. So back to the presentation. Bring on the beta. We're making a second scoring change for April. We are going to add the beta to SPY to the score. It's going to be a 7th scoring component in addition to the 6th that you've already seen. And the result of that is going to be that if your algorithm tracks SPY too closely, you're going to struggle to get to the top. And as a practical matter, what that means is if we had this rule change, Grant probably wouldn't have won with that first month. And the interesting thing is that with the March market so much down, that whoever wins in next week in the March contest won't also will not have a lot of SPY. But we just want to kind of we want to get smarter. You want to learn from these things. We're learning in such a way that that we're adding this beta. All right. Oops. Too much. Outstanding issues. Fundamentals needs more exploration. It's really interesting since we made fundamentals available for the contest in the beginning of this month. We haven't had a lot of entries that are using fundamental data, and I'm a little bit surprised by that because I actually think that there's a lot of alpha, there's a lot of good strategies that can come from going through the fundamental data, and people aren't doing it yet. And so I'm looking for ways to encourage people to submit algorithms that use fundamentals. And the second thing that I want to work on, and this one's going to take more time, is that our default slippage model in particular is causing some pain for some people who are trading some thinly traded ETFs. Our slippage model is good in a lot of measures in the sense that it doesn't it's more likely it doesn't fool you into thinking you have a strategy when you don't, but it's bad in some other measures in that it ends up penalizing you in certain situations where you shouldn't be. And those are typically things like ETFs with really huge market caps but might be thinly traded from minute to minute. And so we're going to take a look at that. I don't really know. I don't have a time frame on when that's going to happen, but it's definitely on our list. All right. Now, that was the whole presentation. Wasn't too long, wasn't too much. And let me get to the couple questions that have lined up. First question, does Quantopian put additional money other than the $100,000 on the winner of a Quantopian Open? The answer to that question is no, or at least not yet. So the only thing that we have promised to do and the only thing that we do so far is that when you win the Quantopian Open, you get to manage $100,000 of our money. We're doing that. We did that in February. We're doing that in March. We're going to do that going forward, and you get to trade for 6 months. So I think at any time, at least for the foreseeable future, there's going to be 6 people who are trading $100,000 of our money each. However, in addition, we are working on building this hedge fund. And perhaps as early as this summer, we're going to be doing an initial launch of, you might call it an incubator of the hedge fund, where we start inviting more people into, like, we're actually going to construct a mini version of the fund for to make sure that we can execute the way that we want, and we can to develop a track record for us to get more partners involved. And so at that point, the people who are winning the Quantopian Open are going to be obviously leading contenders to join that fund. And when we do that, we're going to be working out separate negotiations with them to essentially license their IP to use within the Quantopian Open. So kind of the short version of saying that is, we won't make any money on your intellectual property unless we sign a deal with you that explicitly says that. I think I answered your question there, and if not, please ask again, Andrea. All right, next, Andrea had a comment. It says, in order to remove the noise from the leaderboard, you can make it private for a week, and during that period, only the participant would be able to check your algo performance, and after that, it would be public, since it's likely to be a steady state. That is true. We definitely could hide it. I think in general, we kind of tend towards transparency. We kind of we'd rather let people see things. It's also kind of a little bit weird if all of a sudden people start appearing on a leaderboard and they already have a week's worth of track record. So I definitely agree that that is an option, but in the weighing it, I kind of like just letting it show, even though it has some warts. Emiliano says, will the Quantopian Open last forever? Oh, Emiliano, nothing lasts forever. When we launched it, we knew we needed to guarantee at least 6 months, just because we wanted to guarantee a certain, longevity to it. We have been really pleased with the results, and so I expect that we're going to continue it for longer than 6 months. My current expectation is that we're going to continue it indefinitely, but I'm sure it won't actually truly be forever. I can definitely also see, like, there's going to be some more versions of the contest that are going to come out, I think, at some point. So, for instance, I said early on that we're looking for uncorrelated uncorrelated sources of alpha. And one of the ways that we think that we can do that is we can start enabling people to have access to bigger and different and more unusual non-traditional data sets. So I can imagine us doing things like, say we're going to open up to, I don't know, the Singapore stock market. And then maybe we'll give a prize to the best algo in the U.S. market, but we're also going to give a prize to the best in the Singapore market because we want people to write algos in the Singapore market. And similarly, we're working on futures, and maybe I'm going to want to encourage people to trade futures because you can get different sources of alpha by using futures. So there's definitely there is more change coming for the Quantopian over time, and I don't have enough of a crystal ball to tell you exactly when or how that's all going to happen. All right, I got 2 more questions just came in. Maybe there's a question a little out of context, but I'd like to know if derivatives will be included in the near future. Nicholas, the current battle plan is, so obviously we have U.S. equities available today. We have started work on the back end on futures, U.S. traded futures, and so that's going to include things like commodities, indices, a little bit of foreign exchange exposure, a little bit of foreign currency exposure, but it's all going to be things that are denominated in U.S. dollars. I don't expect that we're going to be adding options. I don't expect that we're going to be adding bonds, except for as they're traded as ETFs or futures or whatever. And I imagine after we do futures, we'll probably start doing some foreign exchanges, like maybe India, maybe Singapore, maybe Japan, maybe London, maybe Germany. I don't know exactly what it's going to be. But I guess I would basically say you should probably expect futures to happen, later this year. If we're lucky, this summer, this fall, something like that. If we're not lucky, it'll take us till the winter. And I'm hoping I'll be sad if it takes us to the winter. And then at that point, we'll look around and say, what's next? Let's see. So every month, someone can have the chance to manage $100,000 of your money. Where do you get all the funds? Emiliano, we are venture-backed, which is to say we have a number of venture capital companies who have invested money in us for our capital operations, like in our operations and product building. And we're using that VC money as the backing for these algos, obviously with their blessing. They know that we're doing it. And I guess it's also worth pointing out that we limit our exposure on this in that we say that if your algorithm, once you start trading, loses $10,000, we're going to stop your algorithm and we're going to stop trading. So we're pretty much limiting our exposure to the worst case scenario is that we'd lose $10,000 a month. Now, obviously, we'd rather not lose $10,000 a month, but at the same time, that kind of money isn't going to make us or break us. And since we're doing people for, like, you win the contest, you trade our money for 6 months, that means that every 6 months we have another $100,000 that comes free. So we're committing $600,000 to capital to this, and we're going to lose, hopefully, a maximum of $10,000 a month, and more hopefully we just lose nothing at all. It's just money that sits in your bank account instead of ours, effectively. All right, Michael says, if Quantopian doesn't look at the submitted algorithms, how do you know there aren't many algorithms using fundamentals? Michael, because I can track calls to the database. We don't look at what the actual calls are. Like, I don't know, like, if people are looking at EPS versus market cap or whatever. But if you've got an algo that in the beginning of every day queries get fundamentals, then I know that you're using get fundamentals. So we have a pretty fine line about that we're careful about in terms of what we can look at and what we can't look at. And so one of the things that could happen is your algo could be doing things like you could query get fundamentals every morning, but you would never use the data, and I wouldn't know. I would actually just assume you're using get fundamentals. Yeah. So but if you're not using get fundamentals, that I can be really sure of because you just don't even run a query. Paul says, why no options? Options we don't have, because the combination of effort to reward, adding options technically is very difficult because you have a whole new concepts like the option chain, and so our back end and all of our database is not designed. We are used to thinking about an instrument, and it has a high and a low and a volume and a close and an open, and whereas when you look at options, you have to think about not just an individual option, but you also have to think about the whole option chain. And plus, they're very thinly traded, and so that means you have to start looking at bid-ask as opposed to as-traded data if you want to actually price them. And then you look at it and you say, options are by and large derivatives of, of the underlying security. And since we're looking for uncorrelated alpha, the options end up being pretty strongly correlated with the underlying U.S. equities and underlying equities in general. And so that's just a whole bunch of effort for us that doesn't actually lead to uncorrelated alpha. So that's the short answer of why no options. All right. I don't have any questions queued up right now, so I'm going to go into my closing spiel, but if you have a question, please type quickly. My name again is Dan Dunn. I'm the VP of Product here at Quantopian. If you have any questions for me, my personal email is ddunn, ddunn @quantopian.com, and you can also email us at feedback@quantopian.com, and I guarantee you'll get a faster response from feedback because we've got a team of people who answer that one, and I'm the only one who answers my inbox, and I assure you it is not pretty right now. Let's see. But all questions are welcome. Andrea says, are you going to provide universe implementation other than dollar volume universe? I'd be interested in a way to filter securities by their ATR or volatility. Andrea, the answer is yes. Well, the good news is we have provided a whole bunch of universes already beyond the dollar volume, and specifically because you can create your universe now doing things like get fundamentals. Like you can say, I would like a universe of all large cap stocks that earned more than $1 million or $100 million last year. So you can do things like that to create really powerful universes already in our fundamental, using fundamental data. However, volatility is not something we have currently available in a way to create a universe. That's something you'd have to do externally and then load using our Fetcher data. So we do also have a way of creating universes using Fetcher, so that if you have a list of stocks where you knew that this is the most volatile stocks yesterday, I want that to be my trading universe, you could bring that in through Fetcher. And yes, I really like the idea of being able to create universes based on volatility and price behavior. That's probably not too far off, but unfortunately it doesn't exist. That particular flavor doesn't exist right now. So we've got a lot of universes, but not that particular one. Joshua says, maybe too far on the time horizon, but what slippage do you expect when one might invest personal money? Well, the good news is, Joshua, is that that happens already. We have we've been trading real money on Quantopian for more than a year now, and we have hundreds of people who use their algorithms to trade using interactive brokers, and the slippage that they see is actually in general much smaller than the slippage that's in our backtest, and that's because our backtest is more conservative. But it's like with everything else, we have a default slippage model, and every security is always a little bit different than the default. So I can't say that every trade is better, but I can definitely say that most trades are better. And the other thing it's maybe obvious, but I'll say it anyway, is that when you're trading real money, there is no, quote, slippage model. You're really only getting the actual slippage. Like, you get the exact price. It's, you place your algo places an order with your broker fills that order, and there's no nothing going in there that adjusts any price. It's literally just whatever the fill was. All right. Andre says, Sharpe ratio and stability of returns metrics not always good because they deal with bad with upside volatility. Do you consider to update these metrics? Andre, you have reached. That's an interesting question. The people who are actually deciding on our fund composition. I do a lot more of the software product stuff, and the actual fund composition are a different team of people here, and they can answer that question a little bit better. And so you could either send that question to feedback, or you can, there's a couple different forum threads already about how we're constructing the portfolio, and you can think about, and you can suggest, bring up what your concerns are. I know that in general, what our philosophy is we're looking for very predictable, stable algorithms where, we do not want volatility, and we do not want drawdown. So slowly going up and to the right is preferable. Hit a lot of singles, don't hit home runs. And I suspect that the reason that they chose the metrics that they did as opposed to the metrics you're suggesting is because of that philosophy. But I'm not quite educated enough on the answer to give that to you. So sorry I don't have a better answer for you on that one. Michael says, does the scoring algorithm place higher value on quick, risky returns or reliable long-term? Reliable long-term all the way. Quick and risky will not win the Quantopian Open. If it does, it means we've really screwed up. Now, admittedly, with only having a month of paper trading, it's at least possible that you could do something quick and risky and get lucky and win, but all of our scoring factors and all of the backtest and the requiring the consistency between the out of sample and the in sample, all of that stuff should make it impossible for quick and risky to win. You never say never, but we're trying to build a fund that is based on reliable and long term. Paul says, pandas.io.data, can I make calls to that library, or do you have to use Fetcher? Paul, you have to use Fetcher. Unfortunately, all the pandas.io stuff is all blocked out within our platform because it's a shared platform, and anybody can run code on our platform, and we have to protect both our other customers and ourselves, and so we have to blacklist certain activities, and so a lot of those things, if you try to access I/O, if you try to access the operating system, if you try to do a bunch of those things, we don't let you do it. Also, please don't try, because our VP of security frowns upon it, and he'll get angry with you. Nicholas says, during the development of including futures of trading, will we see the zipline code updated, or will we be working on the final version will be updated? You're going to see zipline. You should see, in fact, I'm going to do one of those things you should never do as a product manager, and I'm going to say that you're going to start seeing an update to zipline in the next 2 weeks. I actually have I'm going to be putting something out on the forums pretty soon, and maybe a blog post too, about our plan for implementing forums, implementing futures. And the short version is that we're doing the zipline work first. Then so that it'll be available in Zipline, and anyone will be able to use it on Zipline. And then we're going to start doing things to make it available actually within Quantopian, like loading the data, making the data accessible, putting the returns, making the UI work, stuff like that. So it's going to be available in Zipline before it's available anywhere else. All right. I've again reached the end of my list of questions. These have been fantastic questions. I'm really glad that you've asked them, and I'm really glad that I was here to be able to answer all of those. So my name again is Dan Dunn. My email address is ddunn, D-D-U-N-N, @quantopian.com. I invite you to drop me an email, or I also invite you to drop an email to our main line, which is feedback@quantopian.com. This has been recorded, and I am going to post this and the slides up probably even later today. Thank you all very much for joining me. Have a wonderful afternoon, and enter the contest, and tell all your friends to enter the contest. I would love to have more people in the contest. Thanks. Talk to you.